Hi, everybody, and welcome to another episode of Making Risk Flow. Today, we're with Antonio Grimaldi. He's a partner at McKinsey and a dear friend of mine. And he's one of the leaders in the insurance practice across the UK. So I think it's going to be a very exciting episode where we'll talk about kind of where the industry is heading, what are the major trends in the industry, and some of the themes that they're seeing as part of McKinsey in the industry. So first of all, Antonio, thank you so much for joining me today.
Juan, thank you for having me. It's great to be here. Thank you for the invitation. And over the years, this podcast has become the flagship of the industry. So I'm delighted to be able to be here. Thank you again.
Thank you for your kind words. For those in the audience that doesn't know you, do you want to give an overview of your background, your role, where you focus?
Absolutely. So my name is Antonio Grimaldi. I'm based in London. I've been here 15 years. I'm a partner in McKinsey, which is a management consulting company. Myself, I focus most of my work in the insurance space, and being based in London, the London market, Lloyd's market is my playground in a way. So I've been serving, carriers, brokers, private equities on making improvement across the market. And obviously we will talk later about it. This is a very evolving market, and it's very exciting to be able to serve in the space of insurance.
So building on that, as I think one of the things, as I mentioned, that is really relevant from your point of view is you see pretty much the whole market, and you're involved in many of those conversations, and not just carriers, brokers, but also, as you said, investors, private equity firms. So you bring like a really holistic view of the trends, like what's going on in the market. So let's start there. Like, what would you say are the themes that come up in some of those more strategic conversations?
Well, a few come to mind. The first things I would say, this is a very cyclical market. Now we are in a softening period. And the implications for insurers, for leaders, is that many are looking to ways to become more efficient, to outcompete competitors, and prepare for execution of those initiatives. So I think the efficiency in response to a soft market is the first things that come to mind, and we can explore in more detail what that means. The second one, which I think is a bit in the opposite camp, is really about growth. And despite or in spite of softening market, many of the carriers around the market are looking ways to grow. And grow in this case means expansion of exposures as opposed to relying on rates. And here there are a number of implications that we see emerging in the market, because growth means not only new products and customers, but also executing in a very different way. In a market is becoming, of course, more impatient in terms of turnaround, providing quotes, then responsiveness, market responsiveness, customer responsiveness, broker partner responsiveness becomes imperative to be able to compete effectively and grow in the market. So it's a byproduct of efficiency that I talked about in the first place, but also requires different skill set that we're working with our clients to deploy. The third point that I would make is around the distribution dynamics that are, of course, evolving. There are a number of very large brokers, of course, but also a number of new, very fast growing brokers that are also bringing different capabilities. We also seen different business model emerging. Facilities is indeed has become a different way of trading in the market. And so many insurers are asking themselves, how do they evolve their own capabilities to be able to trade in the market beyond the traditional open market way? The four things that I would say is the M&A landscape has been very active starting from the summer, with some important transactions that have happened in this part of the market, which is in a way a signal of the continued relevance of the London market, Lloyd's market, in the global context of insurance. So as I said before, this is an exciting market, is a very relevant market, not only for the UK, but for the globe. And the M&A transactions have confirmed this as a sign of the health and the attractiveness of this part of the market. So I'm very hopeful for the future. And of course, the last word has to go to AI. right? Everyone is talking about AI. Everyone is experimenting now in AI. Now the question is, to what extent we will see P&L impact, on real, tangible, concrete impact on the P&L from the AI investments that are happening throughout the different parts of the market. I'm personally very hopeful, but it's not going to be a short journey. It requires some proper reimagination of various domains, and we can absolutely talk about it.
Fantastic. And probably to your point, I'm sure we'll talk about AI also in the context of the other four trends that you've discussed. But should we perhaps deep dive into each one of those? I think all of them are very relevant. Obviously, they are top of mind for many carriers and brokers. So if we start with the first one, right, efficiency, I would assume the reason why carriers are looking at driving efficiencies in a softening market, you could expect loss ratios to go up. If you want to maintain a healthy combined ratio, you need to drive a reduction in the expense ratio.
Juan, I would take the first two combined, because there is a theme of efficiency, as in expense ratio has to go down, and absolutely this is becoming a gene. But I think what we see the most effective carriers are thinking about efficiency in the context of market responsiveness and service, right? So it's not only about decreasing cost, but it's also about changing the way they operate to become more responsive. And so I found these two things to be extremely connected. Now, on the efficiency point, we have seen, therefore, two different ways to get to cost reductions. In a way, there is the tightening the belt, trying to make incremental improvements, which in our views are, could be efficient, but could be effective by short term. They are not transforming companies. And then there is the other way to think about efficiency transformation, which is really rethinking about the entirety of operating model, process, technology, talent, obviously, and AI. And the combination of all these tools is something that we believe would impact greatly insurers going forward. Of course, it's not easy, it's not imminent. Insurers need to commit and remain focused for a few years to achieve a meaningful transformation. But if you go down this route, then my second point about market responsiveness, call it digitization, call it automation, then we will see some results. And the reason why this is becoming important, I hinted to it earlier, is that of course this is an extremely competitive market in which brokers are trying also to streamline their relationships with carriers, and carriers who are able to be responsive, to quote fast, to be able to understand whether a quote is within appetite or not, and be able to provide a meaningful quote that not only release time from the underwriters to focus on quoting, and therefore increasing the capacity of quoting, but also is able for the underwriter to focus more time on broker relationships, customer relationships, and that, in our view, also drive the growth in the market.
Let's perhaps just bring it to life. What are some of those operating models that you're seeing being successful, that are driving efficiency, but very efficiency, like long-term efficiency driven at how do you drive growth and how do you improve your responsiveness to brokers? Like, what would that look like?
The one thing that is exciting about the Lloyd's market is a very old market, in the sense of if you go in the Lloyd's building, you see a number of very interesting rooms, and the underwriting room is been there for several years. The counter side of that is that at times this has remained a people-based, a relationship-based business, which is what makes the market different. At the same time, though, the other side of this coin is that processes at times have not been optimized, have not been looked at for years, and the tools provided to the underwriters are not what they should be if you were to set up a new insurance from scratch in 2026. Therefore, the example that I was going to give is we have clients who are now looking into not what individual tools, not what process needs to be changed, but take the full domain of underwriting, from receiving the quote to issuing the policy. and rethink about the operating model. By operating model in this sense, I mean the combination of the customer experience, or in this case, the customer as in the broker that is involved on the other side. It's thinking about holistically about what is the process that we expect to deliver. Think about what is the workflow, and by workflow, I mean what activities needs to be done, and then crucially, I would say who needs to do these activities, because in the past we would have said, well, actually, this is a underwriting task. In the new world where we have agents, we have automations, we have tools, and we have expertise with underwriters, I think we need to think about workflows in a very different way, particularly who needs to do what activities. And so by looking into the full stack, right, from the customer experience to the processes to the underlying workflow, and obviously what technology and talent needs to do in order to support that customer experience, and doing that holistically, some of the leaders are thinking about this in a different way, but of course the full market needs to go through transformation to achieve that.
And would you agree with the view? Because as you said, it's like, I think it sounds like at the core of your point of view is a segmented operating model where it's clear like what needs to be done and who should do each of the activities. But even that, I would assume, will evolve for the next 5-10 years, right? You can expect agents doing more and more, like AI agents over time, and then the expertise being deployed in specific areas. So when you talk to some of your clients, is the advice you should first define a digital first workflow? So the actual workflow itself, even if many of the steps are still being done by humans. I think once you've got a digital workflow that where you have control over which activities are being done by humans versus by AI, then you can then really transform that operating model over time without having to drive all the change management.
I think segmentation, it's an important concept in different ways. So first of all, the characteristics of this market is very diverse. So you would have very complex risks, but also in some cases you have very simple risks. So the segmentation in terms of really understanding what different business you're dealing with, and therefore there are different approaches to deal with different classes of different types of risk. And then there is the segmentation within a class of business to understand really who needs to do what within a given submission. That is crucial. I'm not sure if I would frame it as digital first workflow. I would say, look at the workflow in its entirety. Of course, digital has to be the way you treat, simple risks, simpler activities. I think the most important element is to recognize where do you inject expertise, where do you have to inject expertise, but actually you need to inject agents or automation, where you need to inject, straight through processing and digital. So in a way, digital is one of the considerations in what it is a multifaceted operating model, from uber expertise to absolutely no touch and zero ops operating model.
That resonates really well, because even, as you said, even within a given line of business, right? I think what we've seen with many of our clients is you will receive a significant portion of the risks there being, call it simpler, more vanilla, more homogeneous risks that you should be aiming at really driving automation. And then you'll always have a subset of risks that are very complex, one-off, where like probably you've never underwritten anything very similar before. So I think that kind of upfront triage, even within a line of business, and saying, okay, is this risk? How should you be treated this risk? Is this the type of more vanilla one that should go through a more automated one, or is it the more of a one-off one? So I think that is what you're referring to by segmentation, right?
I am indeed, because one of the key challenges of what I've observed in the industry is that we have highly talented, highly skilled, highly paid underwriters who unfortunately spend majority of their times with very simple tasks. And if you were to analyze whether an activity is value added or not, you will find sometimes 40%, 50% even, when you go up in the more complex risks of their time is spent just sorting out information and getting ready for making an assessment, which is what the talent is really for. And so understanding one is, where do I need to spend as an underwriter time and judgment versus where I don't need to spend time? And this is a critical component. And then, of course, understanding where you need to reject immediately. It's not within appetite, and therefore let's not even spend that time. Unless you have the right tools up front, it's very difficult to gain those efficiency gains that I was describing at the very beginning.
So this sounds like almost like it's difficult to argue against that type of transformation and operating model that you're describing. What does the reality look on the ground? So based on the clients you work with, the clients you talk to, how many of them, so where are they in terms of maturity of applying this type of segmented operating model?
I don't think there is a target state which would say that is what you're shooting for. Of course, every year this target is evolving and moving, right? 2 years ago, we're not talking about agentic AIs. Now we do. So this is obviously a shifting target. And as a result of that, there is a variation of maturity in what we see insurers in the market today. Having said that, the reality on the ground is messy, right? This is it's a complex industry. It's a relationship-based business. Each risk is different. Here we're not in a market of let's call it personal lines or even in banking, in retail banking. This is a very complex part of the insurance business. Therefore, has to be messy. That is the reality. Now, with this complexity, it is important to recognize that can be tackled by, again, I would repeat myself, really taking a domain view on the problem. By domain view is that don't focus about what are the specific tools that you can give to an underwriter to improve her or his job. Rather is understanding what is the entirety of the journey that the underwriter needs to accomplish. And this takes time, takes commitment, takes effort, investments to really think through what should be this target state based on the 2026 technology. So, in the reality of the facts, I see highly variations in terms of the level of ambition in the industry and therefore level of investments. That is the reality of the facts because of the industry. I mean, if you speak to all the underwriters, and we do, they, of course, they understand what is their target state. They do understand the amount of improvement opportunity. They are craving for more capacity to be more responsive to customers and broker partners. The question is really the ability of stepping back and rethinking the operating model of how do we underwrite, how do we settle claims, how do we engage brokers for growing our book. So at the end of the day, I think the first thing comes from a clear ambition from the CEOs of insurers to set different goals, and that is the first step towards a transformation. The second step is, of course, taking that holistic view as opposed to individual tools.
You mentioned a couple of times the obviously London market is a very relationship-based industry or market, right? And one thing that probably, or to me, is obvious today, but probably it wasn't 5-10 years ago, is I think historically we all agree it's a relationship-based one, but we almost translated the fact that this was relationship-based to being manual, very manual. We said, okay, it is relationship-based, therefore you need to be face-to-face in front of the broker, underwriting the risk on a piece of paper, right? Because I think now we're almost like redefining what does it mean to be relationship-based, which is often the best relationships are not doing things manually and inefficiently. It is providing the fastest quote back to the broker. And that is how you build a great relationship with the broker. So do you also, would you agree, it's a small nuance, but would you agree with that concept of relationships are not the same as just face-to-face all the time? They are closer to something, which is how do you provide the best service to the broker?
Absolutely. I was smiling because I did say relationship-based. I didn't say manual. And actually, the manual element of the market is what comes in the way of, one, developing relationships in the more complex part of the business and being great in customer service across different segments of the market doesn't mean that you need to deploy people everywhere. So the relationship obviously remains for the big risks, the big syndications, for the simpler part of the business, but also for the simple tasks within complex risks. Customer service or broker service means speed, responsiveness, ease of doing business, transparency, ability to stand by your commitments in terms of by when you're going to provide a quote back. The topic of customer service, that's why at the beginning I said the first element of the reimagination has to be what customer experience you want to provide. And in the context of London market commercial insurance, customer experience is, again, multifaceted. It does start with relationship, which is another word for trust, and understanding that as a carrier, you have the right expertise, the right judgment, ratings, capital to safely underwrite a risk, but also it means responsiveness, also means service level standards, and irrespective of the complexity of a given business or a given risk, there are elements that should be accelerated. And in 2026, I don't think anyone would argue for maintaining manual processes which are prone for mistakes, rework, and inefficiencies. Coming back to the very first point of this discussion,
and I think what we're also saying is almost for the first time the industry is able to measure that concept of relation, like the strength of a relationship. And I think in my view, one of the best ways of measuring that is how many good risks do you see from a given broker. That should be almost the a measure, or the best measure, of the relationship between an underwriter or a carrier and a broker.
One step before, which is in a broker-led market, speed to a clear yes or a clear no. That's
exactly.
Per se is a growth strategy. Because then when you have a clear no, brokers will know what you're interested in, what you're not interested in. A clear yes would then signal that you are on it, and therefore then you need to gear your processes to maintain the service level standards, because you said a clearly yes to a risk.
And I think many insurers have already demonstrated that the speed of a clear yes or no, and ultimately the speed of an ultimate quote, it actually correlates with the volume of risks they see from that broker, right? So I think probably again, a few years ago, it was less obvious to correlate the two, and I think this is something many carriers are doing today.
I think the other thing I would add in this space is that we've done some number of analysis about what really drives performance in the market. Is it where you compete, what lines of business, what segments of the market, what industries you're focusing on, or is it how you compete, meaning execution, operating model? And surprisingly, this is a very high level number. We'll say here, 40% of performance is driven by where you play. So what lines, or what is the makeup of your portfolio, and 60%, it is about how you compete within a line of business. So when sometimes, people ask me, of course, portfolio strategy is absolutely important. But, once you're committed to a set of portfolio, thinking about within a line, within a portfolio, how you compete, it drives majority of the outperformance. So again, it may be not exciting to talk about processes, technologies, operating model, but this is how you win in the market. And insurers who are focusing on relentless outperformance on execution, those are the ones who win. Why? Because they give a clear yes or no, they're responsive, they're efficient, they know exactly what they want, and they are redesigning workflows and technology to do exactly what they said to brokers and clients that they can underwrite.
That is, I think, brilliant and super interesting as a data point, because I think probably, again, years ago, you would think that as you go to a soft market, that the only driver of outperforming the market is, can you adapt the size of each of the lines of business to the market conditions? I think what we're saying is that there's obviously a component of that, right? You should be writing less of the less profitable lines, but it's a bigger driver of that is actually in the lines where you stay, like how do you adapt, and what's the service that you deliver.
And as you do that, if you free up 20-30% of the underwriter's time, then there is more judgment, more thoughts in the assessment of the risk, or can create more capacity to then get on the next quote very rapidly. One last thing, because over the last 5 years, of course, some of the growth in the market has been driven by rate versus exposure growth. And we believe that the next chapter is going to be around relevance, service, and productivity. That's how carriers can achieve growth. And of course, in a market which is not growing due to rate, there is going to be a market share impact. Who is able to provide better service, better productivity, better relevance of what they offer. That's how they can grow in the market and be successful.
And how would you define relevance?
Well, relevance, I mean, is really thinking about the capabilities and the offer to the end customers. Are you able to underwrite certain risks? Are you able to provide that risk management services? Are you able to be perceived as one of the leading competitors, insurers in the market? This is obviously in places where there is more differentiation or competitive advantage given by what are the services they offer in the less commoditized part of the market, which, by the way, in its entirety, the London market, and it's less commoditized almost by definition when risks come to London or to Lloyd's.
So we've touched on probably the first two of the major trends we were talking about, efficiency and growth, and obviously the relationship between those two. I think the third one you mentioned was about distribution dynamics, growing into the facilities, some sort of consolidation, but also for like a new players in the market. Like, what are the implications of that trend when you talk to some of your clients?
Well, we can have a full podcast episode on this topic alone. In the sense, we've seen in recent years in the growth of MGAs, we've seen facilitization by brokers. We've seen the emergence on follow-on only algorithmic based underwriters. And what it means is that actually the segmentation or the diversification of the market has increased even more. And so, I mean, the main implication of core, just in interest of time, is that there is not a single recipe for the operating model. And by the way, there is not a single recipe on how you compete in the market given this differentiation. And different insurers can take different stance on. The implication, though, is once you made a choice, again, the operating model is the strategy, right? Once you decided the pockets of the market, the way you compete, again, drives the level of success you can achieve. And for each of these pockets, the way you compete, meaning, to what extent is about talent versus to what extent is about technology, of course, changes based on different pockets of the market. Just to give you one specific example, we have some clients which have the ambition of growing in the portfolio solution, so less open market, less traditional, and the capabilities required in the space are different. Perhaps it's less about an underwriter looking at single risk and making an assessment. It's more the ability of, for example, ingesting bordereau, a number of different policies and making sense out of that. Are we supporting the right markets? Are we backing the right leaders? Are we able to react not instantaneously, but promptly to market changes? That is a very different capabilities from those who are leading large and complex risks as a leader in the market.
Yeah, and that we're seeing recent news, right, of London market syndicates creating this type of dedicated teams focus on this type of solutions, and obviously with to your point, with different operating models, probably different skill sets, different approaches. You're more like almost like a fund manager than a
correct
individual risk assessment, right?
And then if you think about industries which have already gone in that space, they become even more technology-led. Because what happens is there's a higher volume of information to transact, to process, to make sense of. And it becomes more of a index trading sort of capability where, the securities have seen the evolution from the 70s and, where, we used to see Wall Street pictures of traders on the phone. Now it's all technology traded. So in some cases, the investment in technologies will need to increase to bring to life this type of technologies.
Well, yeah, I want to make sure we touch on the M&A. As you said, it's like probably since summer in the last 4 months, obviously We saw the Inigo acquisition, Vantage, which are like really interesting ones. Those are, I mean, and there have been a few others, right? All of them reasonably recent carriers, but with a very strong focus on data and analytics, like service efficiency, right? Like, what would you say have been those themes in the M&A space in the last few months?
I mean, the first thing I would say is the confirmation of the relevance of this market. And by relevance in this context, I mean, these are being considered to be good investments, which means it's a confirmation of the longevity of the Lloyd's and London market in the context of global insurance. That's, point number one. I think the investment thesis have been very, very different. There has been obviously interest in more recent managing agents. You mentioned Inigo as one of the example, which was set up just a few years ago. Incredible success by the management team, but there have been many others, including increasing interest from investors into long-standing managing agents in the UK. So there have been different teams. The data analytics, it is one. Of course, many are wary to invest in the Lloyd's market just because this market is very different from any other, more traditional domestic market. Other themes that I've seen is that there has been interesting capital coming for structures which are providing different ways to underwrite. And I'm referring here, for example, on Apollo underwriting, who has a very interesting model in the market, focus more on fee-based and alternative capital providers. That has been another theme. I would also note a couple of recent structures in the market or transactions which have been facilitated by the London Bridge. Thinking about the recent announcement of AIG and Allianz in how they optimize reinsurance through the Lloyd's structure. So again, this is a market where can support insurance in global insurers competitors in many different ways. So I don't think there's a number of different reasons why the market is interesting, and these are all accretive to the relevance of the market.
Yeah, I think it sounds like the message is a really positive one. It's like really strong. I mean, stronger probably than ever relevance of the London market in the global insurance market. Kind of advancements in technology that really can strengthen, can enable better operating models that strengthen the relationship between brokers and carriers. So when you talk to some of your CEOs, what's the acknowledging that obviously every carrier will be, or any syndicate would be in a different stage of transformation, right? But like, what are some of the questions that come up? What are some of the themes in terms of your advice to them?
I mean, coming back to the point of execution being an imperative, right? As I said, I've been relatively, bullish on the market in itself, on the fundamentals and on the attractiveness of the market. What I did say before is, though, the challenge is to adopt a different operating model and technology. So many of the questions are coming, to us in recent months is about how to think about AI, and everyone is thinking about the promises that AI, from what we see in the external world, can provide us. But what is the concrete P&L impact that we can expect from AI? And that's the translation is not direct. And by that I mean the following: some carriers have been making investments into different tools without a overarching strategy, and they ended up with a patchwork of different solutions that are perhaps incrementally advancing the claims underwriting finance processes. The real question is, I'm going to repeat slightly myself, is rethinking the operating model, rethinking the overall workflow, and then within that design, then thinking where you want to buy standard industry solutions versus you want to develop your own capabilities. And I think actually this it's called a conundrum between buy or build. It's something where we are reflecting ourselves also as McKinsey. AI is not only impacting insurance, also consulting. We are thinking about what is that we want to use a market tool, and what is it actually we want to build proprietary tools which are specific to us. And I think the the answers lie in two layers. The first layer is what I said before. What is the overall architecture? What you're trying to accomplish, right? You need to have this master design of the architecture. The second element is about what is the level of, let's call it competitive differentiation that you can achieve from buying versus building something yourself. And so it's quite obvious, but we would say, for those parts of the processes, parts of the journeys that where it is commodity in the sense of you do an activity in a given certain way. Of course, you want to configure your own way, but is not part of the secret sauce of your company. We would suggest, buy a solution. Of course, without burning bridges, if in a year or two there is a better solutions in the market. But it's very crucial, and we are arguing very clearly that for those elements where it is about how competitor A differentiate from B, those are places where you want to invest internal resources, build your own capabilities, understanding what is the right journey to, say, underwrite a risk, or have a relationship with a broker. Then those are elements where insurers needs to develop their own solutions. That's where the competitive advantage, or in other words, the secret sauce lies. But again, there is not a single recipe, because obviously different carriers have different strategy. So what competitive advantage really is depends on the type of market, lines, class, segment of the markets where they compete.
Yeah, and I think this is something that I think even we've seen probably only in the last, I would say, 6 to 9 months, right? Or probably until early 2025, the decision was quite binary. Like, should we build the whole AI architecture ourselves? Should we buy the whole AI architecture? I think especially the agentic AI framework or kind of model is really it's really opening up to these, I think, more hybrid approach, if I understand what you're saying correctly, right? Which is, surely the solution cannot be you buy everything or you build everything. That sounds like too extreme, right? It's a hybrid model where you're buying the components that are common across any player in the industry, and you're building what holds your IP and competitive differentiation. But it's not a science. It's not a rocket science model. But I think that is.
It's not. But in a way, you need to think about what's your backbone, right? And the backbone is what I would frame the backbone as the end-to-end workflow. Within this backbone, what are the different modules that are required? Not tools, but modules that enable your workflow. And within this context, I would say, yes, absolutely, to your point, it's a hybrid. It's not a simple buy everything, build everything. But for each of the modules across this backbone, there will be different decisions in terms of buy versus build. And this decision, by the way, may change over the years. So I think flexibility of that architecture remains an important component. I think banks have been doing this well for many years, about having very low cost, stable core system, creating a number of different middleware services, microservices, and then exposing to customers a given digital experience. And then microservices within that backbone, within that experience, are changing over the years. So we are arguing for, first of all, ownership from a carriers of the entirety of the design, the backbone. And then within that, we are arguing also for flexibility. And once you have that, then you make choices about vendor solutions versus ingrown solutions, at the module level, at the microservice level.
I would almost take it to the extreme to say those carriers that have absolute clarity on the operating model and buy versus build architecture are by far the ones that are moving fastest in driving efficiency, services, productivity, and growth. So to me, this is not a scientific analysis, but there's a clear correlation with those carriers we talk to with clarity in terms of vision of that, and those who are still just almost like exploring, but with a very clear end state vision.
Well, actually, I can offer even a more quantitative view of the business case, which in our mind is very clear. We as McKinsey have done some analysis over the last 5 years and trying to understand what has been the outperformance of AI leaders in insurers relative to AI laggards. And the difference in TRS, or the total return to shareholders, has been a factor of 6x. What we consider AI leaders have delivered 6x of TRS relative to the AI laggard. So business case is there. We believe is there. It is not immediate. So, but we have a quantitative view of that gives us confidence that investment in AI are not only required, but they will be paying off.
I think that is probably a perfect way. I think that sixfold, like 6 times the TRS metric is, I mean, it's undebatable. So it's more about, I think, I'm sure if we catch up in a year's time from now, I think we'll see that pretty much every single insurer will have at least clarity on that operating model and buy versus build target architecture. I think it's all going to come down to then speed of execution.
Absolutely. Speed of execution, I completely agree. I think speed of getting all the answers right, this is not a quick fix. This is fundamentally changing the way insurers are operating using a number of tools, including AI. This will take, some time. It's not a quick fix. But, of course, everyone should our hope is everyone in the industry is going to be serious about this journey and invest into creating this architecture, this view, and start deploying AI more at scale. I think let me add another thing, because one of the concerns that we're hearing from the industry, and by the way, this is not only insurance, is also broader financial services beyond, is that the industry feels to be stuck in what we call the POC purgatory, right? You have a number of demos, you have a number of use cases. They seem great on screen, but there is an inability to scale up, right? To scale up, to be in production. And so we are very wary of those. And that we would say is not money well invested. You need to have the clear view on how you're going to scale, how you're going to bring down the unit cost of deployment so that you improve the economics of the full deployment of AI. Again, it comes down to having a clear strategy on how you want to rewire your operating model using AI.
Yeah, I fully agree. I think every time you hear somebody saying we've got 500 ideas of Gen AI application, or we've got 100 POCs going on, sometimes that is framed as something positive. I actually look at it as something negative, right? You don't want to have too many ideas. You don't want to have too many pilots. What you need to measure is how many are actually in production driving business value. And the ones that really succeed are the ones that say, we are doing 7 things, they're in production, and this is the business impact.
I will even beyond, Juan, in the sense of business benefit from AI is not only about the technology. Yes, of course, you need to have solutions in production. But let's not forget that, organizations are still with humans in the loop and beyond. And therefore, change management, driving adoption, rethinking about how we operate is a requirement. Otherwise, you have fantastic AI agents which are not, used, are not driving the expected impact. So the organizational change management is something that is, of course, on top of our mind as well.
Definitely. Well, this has been super interesting. Antonio, thank you so much for taking some time to share your views. I think as I said at the very beginning, you see a broad range of insurers and brokers in the market, and it's really insightful your point of view. So I really appreciate it. Thank you.
Again, my pleasure. Very, very exciting to be invited to join you in this discussion. Thank you, Juan.